Joining us this morning, BMO Capital Markets Chief Investment Strategist Brian Belski has a year-end target of 45.50. Brian, it's good to see you. So how does the economy sort of evade what some would argue are increasing effects from rates?
Well, great question, and good morning, everyone. Thanks for having us, Carl. You know, I think it's less about the economy right now and more about the stock market trying to digest what is increasingly becoming normal. If I go back and look at what we wrote in our year ahead piece that we published in November, the predominant theme was this return to normalization. And I think that's what the broader trend is, quite frankly, over the next 3 to 5 years. You have to remember that the average 10-year Treasury over the last 70 years is 5%. And what we think is happening right now is that the stock market, in terms of the U.S. stock market, is entering into this kind of normalized performance pattern of high single digits, low double digits, where earnings will be high single digits. And we'll see some sort of a trading range of the 10-year Treasury somewhere between 3 and 4% or 4 and 5%, in GDP of 2 to 3%. How we get there is we've had shock last year and awe this year, especially considering what's happened with stock market performance the first half of the year. And I think the biggest troubling factor is this whole, I'm getting bored, by the way, with this whole higher for longer interest rate thing. Of course we're higher for longer. Zero was not normal, Carl. Yeah. Zero rates were not normal. And I think what we're going to do is settle into normalized trading. And so I think the investors that have been in the business less than 10 years, they're not going to understand this, quite frankly, because we've reared an entire generation of investors that only believe that you buy stocks because interest rates go down. Interest rates stay higher because the economy is in good standing and the stock market is following suit.
Yeah, it's funny. B of A's got a good desk note today where they talk about the movie Wall Street, 1987, where the real estate agents are going crazy with business with mortgage rates at 8, 9, or 10. That said, Brian, I do wonder if you think the shutdown, if we get it, the strike, if it expands, and student loans can offset any kind of good seasonality going into year end.
Well, good seasonality is kind of what everyone's kind of keying in on. You know, we had a bunch of meetings with institutional clients this week, and there are some fears with respect to the government shutdown. We kind of quelled those a little bit, especially going back to 2011 and saw what happened. You know, the president's approval ratings at that time were much higher than the current president. I think we're going to get a better standing in terms of trying to get this shutdown done faster. That's number one. On the student loan payments, I think that is a bit of a hangover. But remember, you just said in the prior hit that cash levels are up. The consumer's been very smart in terms of their money. So I think in terms of interest coverage ratios on the consumption side, I think we'll be able to weather that. I think the bigger issue is what happens into next year with the added volatility of an election and stock market gains this year that people weren't really positioned for. So I think we could get a quote-unquote chasing factor in the fourth quarter that will cause a lot of institutional accounts and institutional money managers to kind of chase the market.
So then, Brian, how should investors be repositioning now, given all of those confluence of factors? In your latest note, you talk about technology, energy, and industrials historically benefiting during periods of high interest rates. Is it too late for those sectors?
No, it isn't, Leslie, and I don't think it's too late for your favorite sector, financials, that you cover. Everybody hates financials, but I think you think of financials and banks in particular in a very bifurcated fashion, meaning the really big ones are going to do well and the really small banks are going to do well. Everything in between, I think, is going to have a harder time. And then also the scale theme, the theme of scale, asset managers and brokerages can do really well. I think the big banks are going to come out with new products that are going to help cover some of these new debt costs, number one, especially on the consumer, but also on the commercial bank side. So look for that. Number two, value is starting to come back a little bit. And oh, by the way, dividend growth and lower kind of duration assets are starting to work. On your cyclical call, I think that's going to be a call for 2024. I think even more cyclical on the industrials, parts of energy and parts of materials I think can do really well as we start to see increased onshoring and capacity coming back in the United States, really defined by AI and robotics.